Yeah, I mean, listen, it's been a terrific rally. It's been a broadening rally. I think we've quickly forgotten that through the end of May, I believe it was, while the S&P was up a lot, the rest of the index wasn't doing very much. We've had a tremendous catch up on the part of small caps, on the part of mid caps, and they've all outperformed since. And so this encouragement or this enthusiasm we've seen with respect to the economic backdrop has played out in the market. And I think, largely speaking, that's been justified.
And this earnings season, you think it's going to end up being a little bit better than consensus expectations? Because going into it, we're looking for probably down close to 6%.
Yeah, I mean, some of the consensus on the street is probably closer to 9% right now going in. And I think there's always a normal beat rate where you can chalk up, call it 2 or 3% to just companies outperforming by design. But I think that this time around, you're probably going to see a larger beat. I could be wrong, of course. But perhaps the companies are seeing something that I'm not. But my inclination is to think that the consumer continues to hold up, job market remains strong, and the performance of the stocks, while might be a bit too much in terms of too far, too fast, although I don't know how to define that, I think a lot of the price move here has been justified.
Hang on a minute, though, Dan. One favourable CPI print, and it's risk on for the markets. It feels like it's priced for perfection. Are the pessimists really jumping at their own shadows? Can this rally keep trucking, or is a correction risk still lurking out there?
To be clear, it's not just one CPI report. There have been a host of reports that have come in better than expected. And I mean, let me be honest, I was particularly bearish for most of last year and the start of this year. But at some point, as the data continues to surprise to the upside, you have to take stock of that. And I think the most glaring example of that, of course, is the labor market. In the U.S., I had expected there to be much more weakness in the labor market by now than what we're seeing. And so while inflation is coming down, that was always to be expected. The issue is over the next 6 or 9 months. But from a labor market standpoint, which, of course, is crucially important, I think the data has been quite good. With respect to the market, I mean, there's always a correction risk. And one of the biggest determinants of how U.S. equities perform during earnings season is how they perform going into earnings season. So the fact that we've had a big run up here certainly raises the odds that perhaps we have something resembling a correction. But as you look out over the next 6 or 9 months, you're going to have to start to see the economic weakness that we've all been anticipating. You're going to have to start to see that materialize, I think, to justify meaningful downside from here.